Welcome back, AI curious folk, to AI Ramblings Daily Podcast, episode 140. I'm Michael Porrick, your human AI guide. It's Thursday, lots going on as usual. Let's get started. Today's theme, through the roof and sometimes through the floor, the valuation pendulums of this AI tech wave. I want to talk about three companies in particular today: Anthropic, Cerebras, and the Chinese memory company CXMT. We're talking about the wild swings in both pre-IPO and post-IPO performance of these companies. Mr. Market is swinging hard in both directions right now, sometimes in the same day. And the three companies that I'm talking about are good case studies of what's going on, applicable to a wider range of companies in this AI technology wave. Let's get started. Let's start with Anthropic. A couple of days ago, I talked about in a post on Reset to Zero how the company is doing pre-IPO conversations with institutions, trying to firm up its story narrative ahead of its anticipated IPO this fall, which will be the second of the three anticipated mega AI IPOs, of course, following Elon Musk's SpaceX IPO back in June. And then the other end of the bookend would hopefully be, for OpenAI's sake, their IPO sometime early next year. They were shooting for this year, but it looks like early next year. So Anthropic, the company, is positioning its story with investors, and its early investors are also positioning Anthropic's valuation in the marketplace, floating as trial balloons, valuation numbers north of $2 trillion. Recognize that their last private market valuation out there has been around $965 billion, comparing to about $850 billion for OpenAI, which used to be the Coke and now, for now, is the Pepsi versus Anthropic's Coke. So Anthropic's investors are basically arguing that on a relative basis, because Anthropic has tremendous momentum, and I've talked and written a lot about this, that Anthropic has a lot of momentum in the AI coding space with their Claude Code and Claude Cowork applications. Remember, these applications didn't exist a little over a year ago, and now they're the hottest, fastest growing product in the enterprise space, probably in tech history. Over $50 billion as of this June. The company, the investors are floating numbers that may be north of 100 billion, maybe 120 billion this year for 2026, and obviously higher, projected next year. OpenAI is a little bit behind, not that far behind, but we don't know the real numbers. We won't have them until the filings are made public. But the argument is that that valuation could deserve a price to revenue number. This is something that I had the infamous pleasure of floating as a valuation metric in the early internet days when I led the internet research effort in the mid-90s. That was one of the first times that price to revenue became a metric that one would reach for, and I mean reach, because a lot of the business models of these companies were out in the future, very aspirational. Now, the investors here are arguing that because other public companies in the tech space, like Palantir, have traded as high as multiples of 55 times or more, not earnings, revenues, 50 times or more, Anthropic deserves a 30x kind of a multiple, and that would imply a $3 trillion valuation. That would be higher than the peak SpaceX got in its IPO. Remember, they went out at about 2 trillion, traded as high as 2.8, traded as low as 1.3, and now they're floating somewhere between $1.5 and $2 trillion. Elon has that public entity, and he has the other one, Tesla, at about $1.5 trillion. So he cumulatively has about a $3 trillion public piggy bank to play with. And these things are also being used pre-IPO to make acquisitions of other private companies. Anthropic just announced a potential acquisition for $6 billion of a world AI model company called Descartes. I'll have the details in the show notes. So these companies are positioning themselves with investors. Their early investors are positioning the valuation metrics that the media should talk about, socialize, hit trial balloons, and test the upper ceiling. So right now, the Anthropic early investors are basically showing us the property, Anthropic as it were, and saying, look at the high ceilings. Isn't that wonderful? It's a great airy property with amazing amount of light in terms of growth. And so that's where we are into the ceilings and the floors. The ceilings are being talked about for Anthropic pre-IPO, as you would expect in almost every IPO. It's just that there are more zeros here than before. Let's now talk about the other side of the spectrum, Cerebras. This was a very anticipated IPO back in May. I wrote a lot about it. They're a very technically interesting AI inference chip company. They went public in May, had a great debut. It's trading, it went up as one would anticipate and expect, through the roof, as it were. And now they just reported their first quarter, and the results were ahead of expectations. Revenues were 180 million, up 280%. The company raised its annual targets, everything you would expect, but because it competes with NVIDIA on the inference market, and I've said right now, for most semiconductor companies, there's enough opportunity. The pie is big enough for everybody. It's not a binary scenario. But the market is focused on, hey, Cerebras is not as making not as much progress on NVIDIA on the inference side, so they took the stock down about 15% or so. So through the floor, as it were. And this is a classic thing that we see in most of these floor ceiling things, pre and post IPOs. Pre-IPO, the markets are typically more excited about what's possible in the future, sometimes distant future, as people are excited about SpaceX's AI data centers in space and chip fabs in space. Post-IPO, it gets more real. It gets more, what have you done for me this quarter versus last quarter? And that's what we're seeing with Cerebras, and we're seeing that volatility as a public company just out of the gate, as it were. And so the market is focused on binary outcomes here versus NVIDIA on the inference side, even though there's more than enough demand for both training and inference capacity in chips by as many chip companies as possible, at least for the next 12 to 18 months, if not longer. Speaking of which, let's talk about the third company I want to talk about today, and I've written a lot about them as well. It's the leading memory company. It's a state company out of China that went public a few weeks ago. It was up almost 500%. The company is CXMT. I've written about them, and it's going through the roof. Its market valuation has crossed over $500 billion and has surprised everybody by surpassing the peak valuation of China's most valuable company, which is Tencent. Tencent, that has the WeChat app that I've written a lot about. This is the super app that every company in the US, from Meta to Google to Apple to Elon Musk, is trying to emulate, having a super app where hundreds of millions of people do everything, their daily commerce, daily lives, everything in the app. That's what WeChat is. That is Tencent. They also have very popular gaming apps, high margin company, also investing very aggressively in AI, as you'd expect. But for now, CXMT, which is much lower down on the tech stack in the semiconductor phase, in the basement or the lower decks of the ship, as it were, trading much higher on an overall valuation metric. And so it is passed through the roof for now. Again, just out. They've not yet reported their first quarter, etc., but it is going through its honeymoon period. And so it is a notable event that a semiconductor company in China is trading above the total market cap of the leading application services company at the top of the mountain, as it were, in China. And so that's what I wanted to kind of highlight, the floors and ceilings of pre and post IPO companies, Anthropic being the one that everyone is going to have their eyes focused on. Let's go to my overall take on this. These three examples are basically showing us the high stakes balancing act between expectation and execution realities of newly minted and about to be minted public companies, whether it's in the US, in China, or anywhere else in the world. The market is the market. Mr. Market behaves the same everywhere. Greed ahead of the IPOs, fears typically after the company is public, and people then focus on the short-term metrics post-IPO. Sharp contrast to the longer-term perspectives pre-IPO. So we've seen this, of course, not only with the companies I mentioned, but also with SpaceX itself. I gave you the volatility range of the floor and ceiling on SpaceX, and it's all to be anticipated. And it's interesting in the context of SpaceX, just as their lockup is being released for over 900 million shares for additional investors to sell into the public markets. So all of these three companies are managing through the roof and floor expectations, and that is the core job ahead now. So I wanted to talk about that. Let's move to the Gadget AI section of today's episode. Lenovo, which is the largest computer company in the world, incidentally also a company out of China, is managing through Ramageddon, the local supply constraints of memory chips and the surging pricing for memory chips, but they're actually doing pretty well. They just reported their quarter. I wanted to talk about that briefly. They beat expectations. The stock's doing well. They're leaning into the AI server opportunity for data centers because remember they make and sell computers, laptops, and big server architecture computers. And now over 60% of their revenues are on the server side of the equation. There's a lot of detail in the notes if you want to take a look at this. And what's interesting here are these large, whether it's on the PC side or on the Apple side, and I've talked about Apple as well, these companies have some of the most robust supply chains on the planet. So they can typically anticipate these volatile trends in terms of Ramageddon and navigate through them. Lenovo's example is a good example of a company doing well despite the longer term demand degradation that's going on, because obviously people are going to buy fewer computers and laptops when the prices are so high. When you had memory that was less than 5% of the bill of materials of a computer now being 20, 30% or more, you're going to see demand degradation. But these companies are run intelligently and they're managing to sell more of the computers that are targeted at the enterprise space and the server cloud space than on the consumer side of the equation. And so they're managing through it. And I wanted to highlight that navigation exercise again through the roof and the floors of supply demand drivers. So let's go to the questions and answers section of today's show. One question that's come up a fair bit: what's the biggest surprise to me on Ramageddon so far? And the biggest surprise is how well these companies are executing through these pressures. You had Google yesterday. Also, just I talked about it. They announced their new line of Pixel phones. They're managing through the supply demand issues, raising prices not extraordinarily high, but to mitigate some of the impact of the RAM component shortage and reducing the amount of RAM per unit, etc. So I've been relatively impressed by the ability of every company that I've been tracking, whether it's on the laptop or the smartphone side, being able to navigate through this. And that navigation to date has been good. So that leads to the second question: what's the thing I'm still worried about on Ramageddon? And it's the obvious one, which is that despite all these navigation exercises through these stormy waters, the attempts to mitigate the financial impact, especially for the larger companies that have immense global supply chains and flexibility, the real demand destruction is still in the cards, whether it's on laptops and smartphones, gadgets of all types. I've written a lot about this, and that's going to be measured in the hundreds of billions of dollars, and that it extends the transition of the growth of local AI compute to supplement the immense demand on the data center side of the equation, what I call the transition of mainframe AI to local AI. And that I was expecting that to be in a relatively short period of time, in 3 to 5 years. That may get a little bit extended as consumers basically wait on upgrading their smartphones instead of upgrading it this year, maybe next year, if prices come down a little bit or we have some relief on Ramageddon. So that is the thing I still worry about. So that is our show for today. I wanted to highlight today's episode 1177, which was Reset to Zero. My post is on Google's new AI chief, who replaces Demis Hassabis of DeepMind, KK as they call him. He's moving from the UK to California and reporting to CEO Sundar Pichai. And my thesis is that Google is actually more aggressively positioned for AI than people think relative to the frontier models. There's a lot of detail there. I'll refer you to the post today to take a look. Tomorrow we'll be back, of course, with ARD 141 and Reset to Zero 1178. And I look forward to seeing you again. Thank you for joining us today, AI Curious folk. Stay tuned.